And that's where you find the bargains. You find the bargains in the flea market in Texarkana, on the side of the road, although statistically 99% of the stuff is garbage. But you generally do not find a bargain in Sotheby's, because Sotheby's has very highly paid and educated appraisers of the assets, and the people that are in the auction are sharpshooters. The shipping companies are notorious for just making the same mistakes. Rates go up, enormous cash flow. What do? They build ships. They build ships when they should be selling ships. I mean, I'm not a manager. I'm a capital allocator. I'm an analyst. I'm not an operator. And oftentimes, investment managers think that they know more about the operations of the business than the business people. This guy said he went to Harvard. Call Harvard. He didn't go there. The account receivables are 400 days. That alone is suspicious. If you call some of their big customers, they will deny that they're sales. We're the largest shareholder of a specialty retailer called Build-A-Bear. It's a very simple business, right? It's like crack cocaine for 4-year-olds.
That's Carlo Cannell, a hedge fund manager who is very well known in investment circles for his track record and in the mainstream media for his hilarious letters to board of directors and managers of mismanaged companies. Take, for example, his call-out of Jim Cramer. And I'm not even showing the entertaining part. Because of these letters, many think that Carlo is an activist investor, which actually is not accurate, as I found out during this interview. We covered much ground in this discussion: bargain hunting, valuations, sizing of positions, times of exit, short selling, and many other things I found very educational. So without further ado, actually don't forget to subscribe. And now, Carlo Cannell. So I was doing research on you, and I ran into this Reddit, not article by post, somebody kind of made like deep dig into Carlo Cannell and what you've done in the past. And he concludes the article with the following. And I want to see what you think. Carlo Cannell is a madman. He is really good at finding deep value stocks like Godeker. His jovial yet assertive riling up of management often attracts the attention of other shareholders who join him in their verbal assault and may or may not be followed with threats related to litigation or SEC involvement. His tactics are unusual yet effective. And then he proceeds like, hey, I really like him. I'm going to follow what he does, blah, 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 blah. Like, how close is it to reality?
Sometimes people focus on certain things because they're more salient, because they may stand out. We always run hedged money, long and short. And sometimes companies will pick upon the fact that because we do practice short selling, then we are satanic, or we are only looking for the hole in the donut. And I think that's taking things out of context is a disservice to the manager. So do we do some activism? Yes, we do. It's something that I'm personally trying to lean away from, but it's only a piece of what we do, and it's only by default do we take up the hammer. Number one, we prefer to invest with management, with allocators that don't need to be told what to do, right? I mean, Warren Buffett doesn't tell the managers of See's Candy that he bought probably 40 years ago for almost nothing. He doesn't tell them what to do. And that's my preference as well. But if it's believed that a board or management is stealing from my limited partners, as a fiduciary, I have a responsibility to minimize that or to stop that practice. Now, in the case of Goedeker's, which was not a successful investment, it's one of these hollow victories, like I told you so. Because if you look at what's happened to the company and the litigation by others, the class action, the settlement which the CEO made after he was fired for cause, you might conclude that we were correct in believing that something was wrong. If I haven't already made it clear, I want to make it very clear that I don't spend my day trying to extract value out of mismanaged enterprises, which is what most hardcore activists do, right? They see value and they mine it through tweaks in the balance sheet or in management. And I prefer not to do that if I can.
Yeah, it's interesting. Like, as you said, the most entertaining things are amplified. Most of the people who probably have heard of you think of you either activist or short seller.
Right.
Like, how do you describe your investment style?
So I'll try to say it in as few words as possible. The core of what we do, and defining core, is where the profit and loss comes from. And this is today marks the 31st anniversary. Coincidentally, on this call, the 31st anniversary of the core fund, which is Tonga Partners LP.
Congratulations.
Thank you. Most of the profit and loss has been through what I call private equity in the public market. On the long side, of course, is just studying up on massively dislocated companies and taking large positions, concentrated positions in those companies. And it has a tax advantage and it has a compounding advantage, because if you find these enterprises and you have the courage to really take large positions, they're not up 20 or 30%. They're 10Xs, right, over time, or more in certain cases. And so I would lead with that. That's our core. And the short selling at certain times has been very beneficial. And we could drill into, say, year 2000, 2001, 2002, where our results were the inverse of the indices, right? Like, I think it was NASDAQ was down something like 34% in 2000. We were up about 34%. And then the NASDAQ was down, whatever was down, 30%. And we were up, 35%. Short selling does play a role in it. But if you were to go back for 31 years, my belief is that the activism and the short selling would be very subordinated to the core of just finding these companies, buying them, and holding them.
And these companies, what's the typical profile of them? Like, let's start with market cap. Is it up to X?
So there is a great distribution and characteristics. However, they tend to be small cap to micro cap, and in some cases, nano cap. So that would be one defining characteristic.
Can you define those for people who are not familiar with?
Well, you mean what the cutoff would be between those various labels? I don't think there's any hard and fast definition of what a nano cap is or a micro cap, right? Different parties have a different prescription or different definition of what that would be, but they're very small companies, right? A more precise description is what we call analyst ratio, AR, which is not account receivable, but it's the population of publishing sell side analysts, right? And if you were to parse that out, you were to distribute that out, let's start at the other end of the spectrum, way down the X axis. Let's say companies that have 35 or more publishing sell side analysts, right? Goldman Sachs and Morgan Stanley and blah, blah, blah. The result of that simplistic screen is very large cap companies, very excellent companies, Microsoft, Exxon, Procter and Gamble, Coca-Cola, and so forth. Very highly scrutinized, very liquid, and just not something that I play in at all. I don't even know what the symbol is in Coca-Cola or Procter & Gamble. It's just a different, and I would also argue that most of the large funds are trading these stocks back and forth between each other. It's extremely hard to get an edge. In my opinion, you might as well just pick up the phone and call Vanguard and buy whatever it is, the Vanguard mega cap, blah, blah, blah. If you move way over to the y-axis, you have an enormous population. Let's just say 0 to 3 publishing analysts. Well, you're not going to have Goldman Sachs. You're going to have some of the lesser broker dealers that are publishing estimates on these companies. And that population, it depends, it varies, but it's in the 8,000 range of companies. Now, that I need to footnote and say there's a great range interpretation of what the population of public companies is, right? So you have, I think the old Merrill Lynch quantitative department had a population of about 6,000. Ours is much larger because we include companies that have tradable debt or companies that are, are semi-public, right? I own some shares in something called LICT. It's controlled by Mario Gabelli. He happens to be the CEO. It trades for about $20,000 per share. It has, I think, about 30,000 shares outstanding. But it does make periodic filings with the SEC, and therefore it would fit our definition of being a public company. Some people would not really consider it a public company, and so forth. So anyhow, back to these 8,000 companies. Unlike the Procter and Gamble's and the Microsofts, they tend to be very low capitalization. They tend to be illiquid, and 95% of them have very little investment merit. They tend to be just priced the way they are, neglected the way they are for good reason, right? But there's often a little vein of opportunity within that very large population. It's a very inefficient market. And so we use quantitative skills to try to come up with stuff that is exhibiting some positive trend, is suggestive of something going from terrible to bad or bad to fair or whatever it might be. And in that regard, it's much cheaper. I think we have an advantage over private equity, right? Because the valuations are much lower, and there's no auction process, right? We can take large positions and take advantage of the market's appraisal of that equity versus private equity, where you go through a more efficient process of appraising the equity. So it's somewhat like being a garbage man and trying to find that whatever it is in the garbage heap, that old bicycle frame that is, could be construed to be a collector's item or painting or whatever it is. And that's where you find the bargains. You find the bargains in the flea market in Texarkana, on the side of the road, although statistically 99% of the stuff is garbage. But you generally do not find a bargain in Sotheby's, because Sotheby's has very highly paid and educated appraisers of the assets, and the people that are in the auction are sharpshooters, right? They are able to bid, to appraise those assets relatively close to their actual value. The side of the road in the flea market doesn't mean that just because you pull over, you're going to find a lot of underpriced merchandise, but you statistically have a greater chance of doing that. Versus market capitalization, I think it's better to say we gravitate towards companies that have little to no sponsorship by the sell side. We can't measure for the buy side. A buy side firm is not going to release to its competitors their knowledge, their estimates, but the sell side does, of course.
So walk me then through your investment process, because it sounds like there is a giant universe of these companies and not a lot of information available about them. How do you screen? What do you screen for?
Well, no, there is a lot of information, right? There is a certain, there are companies that kind of cross over the river Styx into like Hades of darkness, where they will stop reporting, right? That is in an investable universe. That's sort of a subset of what we do, but it's not core. But most of the companies continue they may not have conference calls, they may not attend investment conferences, but they do publish their results on a quarterly basis, and they're readily available, right? There's 129 savings and loans left, and they're all going to be acquired, or most of them are going to be acquired, in my opinion. They're very conservative, the smallest of the smallest community banks. They're very conservative. I'm by no means a specialist in these financial institutions. Some of them have market caps. I was looking at this. I couldn't believe it. One of them has a 1 million market cap. 1 million, right? They're trading at, an enormous discount to tangible book value. They have no commercial loans. They're lending within their community, right? They're taking in the money from the people they grew up with or their children, and they're lending them to their neighbors. I use that just as an example of, the opportunity. The data is all there, and in most cases, nobody follows these companies.
Yeah, I remember that in one of the presentation you talked about, you made money on this space, and you said you have to hit the CEO with a stick to make sure he's still alive.
Still breathing. But that sounds like a pejorative, but which would you rather own? Like a See's candy that has a very good product, a very good brand, very reliable. I think See's, I've toured the See's manufacturing facility in San Francisco. I think it actually has really good management. But, I guess irony, another Buffett gem is, would you rather have good management or a good business? And then his quip is, if you live long enough, eventually you're going to have bad management, but the business will prevail. And so I want to have good management, but what I really want to have is a really good business priced reasonably, right? And within this mass amount of the island of forgotten toys, you don't need to have 100. You just need to have a couple that have been discarded. And that's largely what we do, is apply that private equity approach into the public markets.
If you look at the companies that you were very successful with, the investments, what are the typical industries? Like, I'm assuming you're a generalist primarily, but you still have gravitate towards particular niches probably.
So we are generalists. It's better to address your question by saying select everything except for A and B. And A is biotech, and B is largely mining. Both mining and biotech share a common characteristic, which is there is a dearth of historical data, right? There's spending in mining, right? And there's spending in biotech, but you don't get the full suite of data, right? You don't get gross profit margin in biotech. Certainly in emerging mining, it's just development and development. So we prefer companies where we can look through cycles and see the P&L and see the shift in the cash flow statement and so forth. But it could be consumer, it could be energy, it could be technology, specialty retailing is something that we like. It really could be anything. However, I do believe that analysts are most productive when they enjoy what they do, when they're happy. And so I've always lived by a maxim of preferred habitat. And we have an unusual setup. We have like an X, and I believe, people should come to work. We never closed our office during the pandemic, but gave people the option not to come in if they did not feel safe. We've got the 4 people. Right across from me is a Californian. I'm basically a New Yorker. To my right is a man from Argentina. And to my left is a Russian. And so we have very different East Coast, West Coast, Argentina, Russian. And we debate things. And we look at things and slice them and dice them every which way. And they've developed their preferred habitat. So Oleg is perhaps, he's skeptical beyond his years. But he prefers technology. He's very comfortable in technology. But I think he's realized computer hardware is a very difficult business, right? It may seem sexy, but it's not. Stefano, has come from a country that is approaching 100% inflation. And that's something that's very difficult for Americans to really understand because, we have the dollar bill and we tender that and we receive goods and that's just the way it works. But he's been through a very different reality, right? And so his slant is also maybe a little negative and so forth. But he prefers consumer companies he's more comfortable with. And then directly across from me, Chris is comfortable with industrial companies and energy and so forth. And so a very long way of saying our sectors are broad. We are generalists, but I do believe let the fish run, let the analysts pick up on things, which it comes to them naturally and they understand.
When they found this particular company you guys are interested in, what type of due diligence? So
that it's important for you to understand what we're not doing. We're not getting calls from stockbrokers saying, hey, look at this, I like this. We're trying to derive data, originate ideas in a more disciplined clinical manner through looking at pattern recognition, through association, through various screens that we've developed over the years. not to produce a sale or a buy, but merely to be suggestive of, a certain outcome, right? If you take you undergo a blood panel, a blood draw, then there's a lot of data associated with that. Certain things might be suggestive of X or Y, right? But each individual reading does not mean, that you have prostate cancer or that you have, diabetes or whatever it might be. It's more of a combination of things. So we maintain very a quantitative discipline, and then something pops out, and then we're like, okay, well, let's dive a little deeper. Why is the working capital cycle increasing or decreasing? Or this is interesting. Revenue is decreasing, but operating profit is increasing, right? Or just many, many multivariable analysis, right? It's not just solving for X or Y, it's solving for 7 variables. And then and only then do we're like, oh, it's a specialty retailer, or, oh, they make, specialty films, or in some cases, we don't really even look at what the product is, until sort of get through these initial screens. And then we're all qualitative. We want to know, what do people think about the product? We try the product ourselves, the service. And then, we may or may not talk to management. We usually do. I'm increasingly less inclined to talk to management because they're not the closer oracle to God. They often don't know. They lack the ability to adequately predict their own future. So it's a mixed balance. Through the quantitative and through the qualitative, we develop investment theses, ideally one page, which is a memo to ourselves. Mm-hmm. Why do we own this? And then in that thesis, the first sentence is the most powerful. We own See's Candy because X. And then the second sentence is delivers the second most important fact. And then the last sentence is more sort of to water the intellectual curiosity of the reader. And if we can't write it in a page or two, or we struggle in writing that thesis, then we put it in the too hard bucket and move on. Many of the community banks, we don't own any of the savings and loans that I mentioned before. I just mentioned to it as an attractive category. I would put that in the too hard bucket, right? Trying to figure out a community bank. So then we have the thesis, and then we will scale it according to our conviction in the thesis, which sometimes mean we'll buy a security at, say, $2 a share, and then we might buy a lot more at $6 a share a year later, right? And that's because we think it's cheaper at that higher price because the thesis is more compelling. And it's better to do that than necessarily average down, whereas the thesis is falling apart.
And that one pager is probably one of the kind of merits of a discipline. So to make sure you don't hold it out of hope that things improve. Is it fair? It's
multiple reasons. It's sort of like a checklist to the analyst, to the portfolio manager, why we own it. Mm-hmm. And then also to stay within the parameters of what Buffett has said. We prefer to invest in businesses that we can explain to a 6-year-old with one sheet of paper and a crayon. Now, he's deviated from that a little bit by buying Apple and so forth. But we generally prefer to invest in understandable businesses that also tend to be boring, but the financial characteristics tend to be quite sexy. We're the largest shareholder of a specialty retailer called Build-A-Bear. It's a very simple business, right? It's like crack cocaine for 4-year-olds. It's stealing from the parents of the person. The stuffing the bear, the core is attractive margins, but selling that button to the parent for $1 and you're paying 9 cents. And attempting to deny that child of that button or that whatever it is, that accessory, that's a very good business, right? And it's an experience that is very powerful to the consumer. But it's not an exciting business, right? It's not. The financial characteristics are very good. Free cash flow is incredible, but it's not like a semiconductor capital equipment business, which on its surface seems very exciting.
We'll get to the activism in a second, but so when you enter the investment, you do take into consideration the management of the company, right? And you're probably planning to hold for a considerable amount of time. you don't really have time horizon?
Well, our time horizon is ideally on the long side and on the short side, ironically, is usually very long, right? Because most of our investors are taxable. If we buy an enterprise at a very low price and it continues to compound, there's no reason to sell it. And no reason to sell it because we don't want to hand our limited partners tax bills. And secondly, there isn't an investment in the knowledge of the business, right? And there is in many investors' minds this risk of jumping to this next shiny object, right? And sometimes the devil that you know is better than the devil you don't know. So I think our holding periods are probably longer than many of our competitors on the long side.
And on the short?
Well, the shorts, it depends on the cycle. We really haven't talked about that. I'm happy to do that now, or we can defer it.
Well, we'll defer it a little bit.
Okay.
So you bought this company loan, right? And at some point, you realize things not going as expected, and you start writing them letters, right? When did that happen?
Fortunately, that's in the minority of the time. And,
yes.
A cynic would say, if you have to write these letters, then you have done a poor job selecting appraising the management. And there is some truth to that. Sometimes it's better just to say, vote with your feet and just get out. And sometimes we do that. But sometimes the thesis may still be very much intact, but you might have a board of directors that has just made some well-meaning errors, and it just needs to be tweaked a little bit. Or maybe you just need to keep them honest. You need to make it clear to them that they're being watched, right? Boards are always, when things are going well, they're always in the event of M&A, of an acquisition, they always want more, right? It's never enough, right? There's a 25% premium, but it's inadequate. It's not in the best interest of the owners. And then another, it's always higher and higher and higher. So activism can simply be just a matter of saying, no, you're not closer to God than the owners, right? You are an owner, but you have a fiduciary responsibility to all of the owners, not just a minority of the owners. And what boards often do not realize is we're capital allocators. So we have to look at opportunities on a relative basis, not an absolute basis. So if a company's, let's just say that we appraise the stock at 20, the stock is at 10, and they get an offer at 14, that may be at a significant discount to our appraisal, but then there's the time value of money, right? What is that? What is the risk premium associated and the opportunity cost of waiting for that full appraisal versus accepting that $14 and recycling it into X or Y? Boards don't get that. They are not looking at it on a relative basis, right? There may be much more attractive opportunities, say, in energy today. And if a specialty retailer is being acquired or there has been offers for acquisition, the board has a fiduciary responsibility to consider the input of all of the owners, not just the owners in the boardroom. And that's where activism can play a role, where you're just making it clear, you're articulating the perspective of at least us.
When you looked at the companies you had this activist campaigns against, if you could break down how much of it is lack of appropriate capital allocations, like buybacks or maybe just stupid acquisitions they make, versus they just don't even understand what strategy they should follow in this particular field?
It's a good question. I'm going to answer it in the context of what our experience has been, right? Other activists may have other opinions because they pursue different strategies of activism. Most cases, fortunately for us, the board is not terrible, is not unethical, and the same can be said for management. In most cases, they just don't understand capital allocation. For example, if you go back to Build-A-Bear, I'll send you the Build-A-Bear thesis, which were just that specialty retailer. We don't think we like management. We think management is very competent. Let me withdraw that. We think management is competent and driven. I'll remove the very. And it's a good business, and it's a durable business. the company has been overcapitalized, right? The cash flow runs in and then it just builds. They have no debt. It's almost a year ago today. You can pull up the Form 13D or we can send it to you. We have an exhibit, it may be in the thesis, where we are arguing for a different capital allocation policy where the company would tender for a big chunk of its shares. And we provide in the Form 13D in the exhibit A, B, C. C is fairly aggressive. C probably never would happen, but it was tendering for like half the shares, right? But if you go through history and you look at companies like Teledyne, or you look at like this LICT I mentioned before, purchase, almost all their shares, or many examples of really outstanding companies, provided that that's the best use of shareholder assets to retire shares, the results can be excellent. It's a principal way to return value to owners is share repurchase, in addition to dividends, in addition to R&D, in addition to M&A. But buying back shares is oftentimes the best way if done in a consistent manner. So, back to Build-A-Bear, in stage one during COVID, all of the stores shut down, as did many retailers in general and malls and so forth. We were under the assumption that this would not last forever and that it was not, the zombie apocalypse. And so we said, let's just go to halfway normalization in year X. Let's make an assumption that it's 3 years. This is going to start to fade, which is very conservative in hindsight. Let's buy back at, $2 per share. Let's buy back half the shares, right? We revisited, they didn't do it. We visited that last August in this exhibit, which I can send you, calling for them to buy back half the shares at $13 a share. There's a big difference between 2 and 13. If they had done that, then they would have been closing in on about close to $8 per share in GAAP earnings forward 2023, right? Stock's now like at 19. What should a specialty retailer with like 55% gross profits, massive cash flow, what should it trade for? Probably 15 to 20 times. So, stocks at 19, it's so obvious, right, where they should be investing shareholder capital. And of course they started buying shares at whatever, 22 or something like that. And they did a special dividend, which is not bad. They've done a couple special dividends. But the point is, to answer your question, is the boards may think that they understand capital allocation, but many of them haven't experienced and they're not trained in it. They're not investors. And so that's kind of a side of activism that we think is worthwhile. We do not think it's worthwhile in many cases to shame the management, to say what a terrible job they're doing, when in fact they may be trying as hard as they can. And that doesn't necessarily produce a desired result. I mean, I'm not a manager. I'm a capital allocator. I'm an analyst. I'm not an operator. And oftentimes investment managers think that they know more about the operations of the business than the business people. And Main Street and Wall Street are really different. So we try to, going forward, and recently we try to confine our domain to capital allocation.
It all starts with a phone call, or you go with a public?
It does now. No, we much prefer to act with the feather. It's more pleasant and can be more effective. But after a while, if they're not budging, then you need to take up the hammer, sadly. Or you need to come in with the feather with a very clearly know, that there's a loaded gun behind the curtain.
When it comes to valuations, how do you look at the companies? Is it like a comp base, or do you do discounted cash flow?
We try to do the impossible, which is in years Y, right? As far out as you can, how much cash flow from operations, not EBITDA, which I think is a bogus metric. How much cash can this company, will it produce? And then you assign some sort of discount rate. And then you come up with, if you can go out 20 years, great. A company like Coca-Cola, you probably can. In a semiconductor capital equipment business, forget about it. You don't, you don't even know like 18 months out because of the extreme cycles. And then you ascribe some sort of market multiple to that, right? What would you pay for that? it's an art really. And I'm not a believer in this industry group is trading for X today, therefore should be trading for this, because where we traffic companies, they're in a period of transition and dislocation, right? Like there are a lot of medical device companies now that are attractive. Some of them are trading at 1x revenues, and a medical device company that is growing revenue and enjoys the high gross profit that's characteristic of that sector, they should be trading, 5 to 10x revenues. That's kind of the broad range of takeout multiples for these companies. But 1x revenues, they haven't exhibited their potential yet, right? So you need to be more thoughtful in the appraisal.
When it comes to the decision to sell the company, you already mentioned that you try to hold them as long as possible, but at some point you either pull the trigger. You probably pull the trigger, actually. That is,
or somebody else pulls it for us. There's a fair amount. On a regular basis, we have companies that are taken out. Sometimes they're taken out at a price which is above our expectation. It's more often that it's below. Right? We just had a company where one of the largest shareholders of a company called Quotient, and very disappointed, in the price, but we'll accept that because we believe that it is what it is, and the company's probably not going to get a higher price. So in the event that the thesis is being derailed, we tend to just lick our wounds and just sell and take a loss and move on. In the event that the security is well ahead of what we think the intrinsic value is today, then we might not sell all of it, but we might sell some of it. Right? And that's where it really gets into kind of an art,
Situation where you're already sitting on like 5x return. You know that the company is no longer growing as fast, as stock price is probably it's going to go up, but not as much. What would be your strategy? Would you sit there and try to calculate ROI, or would you be like more of a
Well, I mean, that's a very difficult question to answer because it's not framed in enough information that I can adequately answer it. But just on that limited information that you gave me, we would probably we would do what's a trading technique called a curveball, a non-linear. So that's oftentimes you'd be like, okay, well, just sell the position at this price, right? So the portfolio manager is making a linear decision, just sell it at this price. We're more analog. And so we would say, okay, we just hypothetically, stock is at 10. We think it's worth 8 or 8 to 12 or whatever it is. Business is exceeding our own expectations. So we need to reappraise what was the sell point. We would say between 10 and 15, we will sell half the position with greater supply, a greater amount of selling at 15 than at 10. We might sell very little at 10. If you understand why I use that curve, right? And that way it's somewhat programmatic. We don't really think about it, right? Selling, to use your example of a 5x, selling a 5x gain is a nice problem to have. What you don't want to do is start to experience goodness, good feeling, stimulus about a position that has done very well, and not looking at it in an abstract manner. The better question is, would I buy it today? And if I wouldn't buy it today, where would I buy it? Would I buy it at all? And maintaining that discipline in industry, we see it in certain sectors. The tankers, the shipping companies are notorious for just making the same mistakes. Rates go up, enormous cash flow. What do? They build ships. They build ships when they should be selling ships, right? And then 3 years out, they get delivery of these monster assets, and then rates have collapsed. And then they've got all this debt that they put on in connection with these orders for the ships. And so, you want to sell when you can, not when you have to, and you just want to exhibit prudence. And by the way, it's also okay to buy things back. There have been cases where, okay, we were wrong. The company is far exceeding what we thought, and then you go back to them, and it's tough psychologically to do that. but that's often the very best thing to do, right? I mean, think about Apple Computer over the last, 25 years, for example. You could have said 3 years after the launch of the iPhone that the iPhone, despite some skepticism at the time, it's hard to believe that it was a success, right? And therefore you might have said, but the market's appraisal was well ahead of the foreseeable prospects, but you were unable to see 25 years out, and so you could have bought it back. It's a lot of friction. It's a lot of effort. It's a lot of brain damage, but that's kind of how we think about things. We're always sort of challenging ourselves and challenging each other.
Yeah, I find it hilarious when people say, well, if you bought Amazon at 2 and hold until today, you would make this. Like, who did that? No one did that. Everybody sold at some point. And let's talk about short selling.
So short selling is at its very essence is trading. And it's taken me a long time to really realize that. It's momentum investing, but it's the inverse. They're not really investments so much as catching a trend. It's trend following. And I say that with, mixed skepticism, but having done this for 31 years. So we put the shorts into 4 buckets. The first bucket, which hopefully we never get seduced into doing, is valuation. Take a company like Coca-Cola. Should it trade for where it is? You and I can have a debate, right? And one party might say it's overvalued. That's not something that we engage in, because shorting good companies just because they're expensive is really a difficult strategy. The second that you sell that stock that you don't own, you have to buy it at a lower price, and you're expecting that the market to agree with you the second that you make that initial sell to the market. The second bucket, which we do engage in, is hype. We have a spreadsheet from the COVID years. If we just stuck to all of those hyped stocks, real companies that were just hyped up. We had a substantial short position in Zoom, and you might make the case that was hype. Did it deserve to trade at whatever was trading 90 times revenues, or I can't remember what it was. And the third bucket is broken. You have companies that did something, had some growth, and the market has moved away from them, or technology has caught up with them and broken their competitiveness, right? There was a time, if you go back, there was 3 or 4 high-flying pager companies. They were hot stocks, right? They were go-go stocks, and then it became clear that they didn't really have a future. And as that became clear, they were raising a lot of debt and issuing equity in order to build out more networks. But the end was right there. The companies were broken, or were breaking fundamentally, right? And it was clear to us and other people, but there was still an arbitrage between the valuation in the marketplace and where their prospects were. In that case, it's better to wait and to hit them and sort of shoot them in the back when they're when they're broken versus when they're breaking, because you're less susceptible to a bounce. You short the pager companies when they're down 40%, when it is evident that their future, that they have no future. And then the last bucket are companies that are misrepresenting the actual results, right? They're either using financial techniques to misrepresent the actual results, or they're strictly falsifying them, right? They're committing frauds. That is something that we did do a lot of, and it was profitable. It's more difficult now because the whole Reddit crowd and the retail swarms, like locust swarms, can take worthless companies, to us that seem worthless, and they can mark them up to whatever value they want, perhaps in cahoots with the companies, in order to issue equity to perpetuate the nonsense, right? And I could send you some examples of these companies, some of which they're able to do this for dozens of years. Most of them do not. Most of them disappear. The mortality rate of a company being started today, and let me define that, not a company that makes it through an IPO, not a company that makes it through an IPO and then gets into an index. I'm talking about a business registration in Waco, Texas, or whatever it is today. The vast majority of those companies within 3 years will be out of business. The guy that starts the restaurant, the dry cleaner, whatever it is, just the generalized business mortality is so high. It's just business is so tough. And so when you take kind of the antimatter of the S&P 500, the companies that will never be in these indexes, or that were in these indexes and they've been thrown out, and they're really just the worst of the worst companies, they actually, the power of gravity is very compelling to short these companies, particularly when they're misrepresenting the numbers, but you don't know where you are in the manipulation of the stock.
Mm-hmm.
And that's why some very bright people were damaged or put out of business during this whole, the GameStop era of all this other garbage.
Outside of GameStop and AMC, sounds like it's those. I thought those are isolated examples, but from what you were saying, seems like it happening much more than I thought.
Yeah, no, we've particularly in the last month or so, we've suffered enormous volatility and pain in certain shorts where they've gone up. In short selling, you can lose more than 100%. You could lose 500% or infinite loss in theory, where we've had paper losses over 200%. And now a couple of days, within a week, then it's 100%. And then it's like, it's the ability for the retail crowd to believe or to follow these trends. Don't underestimate a swarm of locusts. I had thought that they had been so burned that they wouldn't come back, that their fingers were, singed, right? Whoever bought GameStop at $200 a share or whatever, I would have thought that they would not come back, but they have come back in a certain degree. And so it's all about risk management, and it's all about having a large constellation of these. The better strategy is just to pick the real businesses, but their prospects are diminished or diminishing. In other words, going back to the broken businesses. They don't have to be perpetrating fraud, right? Like restaurants go through cycles. They go through a honeymoon period. They come out popular. We go to them. High percentage of ticket is alcohol, which is really the juice of the profit. The alcohol gross profit is tied to traffic. And then all of a sudden, 3 years later, that place that was really cool, you've gone 3 or 4 times and like, I'm going to try this other place. That place is a little worn. It's a little tired. I don't need to do the Mediterranean theme, 9 times. Right. And so that's not a fraud or misrepresentation. It's just a company that's just it's kind of breaking, or where the hype is coming off. But overall, the best thing is to find kind of the pager companies where the need for these products are just like going away, right? That's what we're all looking for.
But it's interesting. You don't have to have this understanding of the future to short it from 100 to 40. You actually can.
Yeah, it's a different discipline. Well, let's go back to bucket 4, like misrepresentation. It's a very different type of due diligence. So if you have a company that has, like, some of the things we're short, there's one that's got, like, I'm trying to think of the mixed one, say Canadian Goose, right? Which makes the $2,500 down jackets, right? I'm talking about?
Yeah.
And so they have something like 400 days of inventory. It doesn't make sense, right? So you've got this bulging inventory, right? You've got a lot of competition. You've got a very powerful brand, a little circle thing.
The red one.
But everyone has these, right? Everyone has an Hermes, whatever it is, clutch. If everyone has it, then that elitism is diminished. And so those things like Canada Goose resonate more with us for shorting because there's a lower probability of us getting really hurt. It's in this kind of slow grind of missing numbers, management making these unreasonable forecasts of prospects, make a quarter, miss 2 quarters, competition. The apparel business is a bad business. Right? It's just tough.
Yeah.
And then, it's how do you anticipate? How do you possibly predict what a teenager's preference is? It's a very volatile, fickle thing. And some of them are like, well, the Canada Goose jacket, I would be caught dead wearing that. That's what like old people wear. And so that would be an example of a breaking company. That's more attractive to us than necessarily finding a fraud and then expecting the world to recognize that it's a fraud.
That's your favorite type of short, right? The one there is this.
Yeah, I think the breaking or broken companies are really our favorite type. There's less pain, and then you can add to it and add to it. The frauds are great when the regulators usually come in years after the fact. Like some cases years ago, we give them the information. It's like, this guy said he went to Harvard. Call Harvard. He didn't go there. The account receivables are 400 days. That alone is suspicious. If you call some of their big customers, they will deny that they're sales. So they're booking these as sales, but the cash flow statement is backing them out. They're not getting paid, and then the regulators was, that's very interesting. And, when the stock's at 0 2 years later, they'll do an investigation. That's unfortunately one of the problems with shorting the frauds is there has to be some event, sometimes it's regulatory, that exposes all of this, or you have a short selling activist, which we are not, will issue a report which exposes all of this stuff, Muddy Waters, or one of these firms that do very good work. I think they are wrongly smeared because they do have an agenda, but I would argue they are providing a public service by educating the incremental buyer about the facts of these companies. That's certainly is not provided by the company that's perpetrating the fraud, and certainly not the sell side analysts that either may be lazy, naive, or maybe part of the rig in order to issue equity to the unsuspecting public.
When it comes to sizing of short positions, given they almost unlimited downside, I'm guessing you're not trying to be concentrated there.
So there's no precise calculus behind the answer I'm going to give you. It's just merely, I have a higher tolerance for short positions than my colleagues. And that's because I know what's going to happen, or I believe I know what's going to happen, but I don't know when. I'm not saying this is a good thing. It may be a good thing that you're just like, well, we have a high conviction that this is going to go to 0. The stock's going up 60%. I don't care. I'm out. I'm buying it. I'm buying this. I'm buying to cover this 0 because I don't want to experience the pain anymore. I'm more inclined to add to it during the tout. And that has not been a successful strategy this year. It was last year. And so 2% is where I start to just get worried.
Yeah.
But another person, some of my colleagues, it's 90 basis points, becomes a large position. And there are people, successful short sellers that have 100 positions, each of which are 40 basis points each, right? And that's fine. That's just a different strategy, different style.
There is a clear advantage of investing alone in the companies that are underfollowed, but when it comes to shorting, isn't counterproductive though, or I'm wrong?
So the way that the strategy is set up, it's really two strategies that happen to be in the same fund, but they're really completely disconnected.
Okay.
Right. And the idea is if you find a breaking company or fraud, it doesn't matter what the market does. If you're good at what you do, right, then that side will produce profits regardless of the market, right? If you have somebody who is misrepresenting the facts, or a company, the pager company, which is an obvious example, the market, whatever index you want to provide, that company's equity is going to go down. And then you take off one hat and then you put on another hat, and you're focused on these long positions that are dislocated private equity type positions. When things go well, you've got outsized returns because you're buying these beautiful gems that are neglected. They're just sort of chugging along at their own pace with very little sponsorship. They're kind of dislocated from the market, uncorrelated, because nobody's really looking at them, right? As I said before, it might be one analyst at some regional brokerage firm that's following them. They haven't been activated. In some ways, they haven't really come public. And then on the other side, you've got these very high beta shorts that are extremely volatile. But if you get on the right side of those, both sides of the spectrum, right? This is where we are, right? We're just very, very far in terms of similarities of the characteristics of the securities. That's what the strategy is supposed to do.
How much of your work dependent on LPs you've selected?
You mean mining the partnership for specialty information?
Not necessarily. Like you have this high tolerance for shorts, right? A lot of times, LPs would be the ones who put pressure on the GPs, making him or her.
No, not my limiteds. After 31 years, I think they just leave me alone. I don't really. I'm happy to talk to them, but it's a different. You achieve a certain level of credibility after doing this for a while. And you also have to keep in mind, this is not necessarily for everybody. What we do is, it's like if you're going to make an apple pie, you have to have cinnamon. If you don't have cinnamon, it doesn't, or baking soda or whatever it is, we're not making the pie, right? The pie is Goldman Sachs Asset Management. You want alternatives, you come to us. Right. And then we will give you alternatives, or we will give you private equity, or we'll give you real estate, or whatever it is. And then they might come to us and say, okay, we know what you do and we need that little ingredient. So generally speaking, that's more of our limited partner versus an individual. We do have individuals. We're happy to have individuals, but they tend to be more, hey, this is a piece of what I'm doing. And it's inappropriate for them to try to influence my decision. I just wouldn't listen to them or take their call or expel them.
I keep hearing from active managers, particularly the ones that manage large caps, that it's becoming increasingly difficult to outperform indexes. How is it on smaller cap spectrum? Is it similar?
It's very volatile. It really depends. We could send you some cases of outperformance where it's not just a little bit, it's enormous, right? And there's some cases of underperformance as well, right? And so we are not the fund to invest in if you're trying to outperform X or Y index on a weekly or monthly basis. And you need to take sort of a longer term view and just average it out. And we have achieved that, over 31 years, but not in a linear manner. So if you go back to these longs that we have positions in, for example, one of the theses, I'll just make a list here, like TrueCar, right? TrueCar is an abandoned company. I don't know who follows it. 2 people, something like that. It has a market cap, has an enterprise value of about $25 million. It has an enormous amount of cash, no debt, and they bought back probably 20% of the company, and they have an enormous reservoir of data on car inventory. It's a tool that the dealers use to generate leads, right? The car dealership business is a very large and very profitable business. Last couple of years, there has been no market for these tools. If I can't get product, right? If you want a Subaru Outback, take a place in line. You're number 25. I'm not going to spend any money trying to attract you to come into my dealership. I just sell the cars that come in. Anyhow, you have a company like TrueCar. The results are improving very, very subtly, but there's no reason. There's one reason maybe to rush in and buy a lot of it. I'll get to that. But right now in here, it's just trading like it's almost like no valuation, right? It hasn't been activated. It hasn't come public really. I mean, it was a high flyer years and years ago, but I'm telling this to you because we're not buying this for a 30%. This is like, a 10 bagger when it starts to exhibit what we think it will exhibit. However, in the meantime, 2 months ago, we turn on our machines and there's AutoNation has bought 8% of the company. So we own 8%, they own 8%. AutoNation is one of the most sophisticated automobile dealerships, chain of dealerships in the world. And they have a reputation for using technology for their benefit. They do not have a reputation for trading their treasury, and they're not stock jockeys. They're not buying 8% because they think the stock's going to go up 50% and they're going to sell it. It's not what they do. They buy companies that are strategic. This company is strategic to what they do. But I can't tell you when TrueCar is going to appreciate. And so that's why returns are sometimes so uncorrelated. I just simply don't know. I know that there's more inventory of cars coming into the dealerships. It depends on the brand, right? And I know that history will repeat itself and that the dealers will spend to acquire customers, to do transactions. But I can't really tell you with any specific knowledge it'll happen and start happening in 8 weeks or 8 months.
You started the fund, you said 31 year ago to date.
July 1, 1992.
I've read that you started with 600,000.
Yes. 100,000 of which was my capital.
And then eventually it grew to billion, but I'm guessing it's a combination of new money and...
Yeah. Oh, yeah. $1 billion plus, something like that.
And you decided to return some money to investors, which is unusual.
Yeah, about $500 million we returned.
What was the reason? Because you didn't think you can find good investments?
When I went to university, I was going to be a classics major. Then I found out that you had to be there at like 7 a.m., which to a college student is a horrific reality. And so I transferred majors. But in studying Latin, there's a word, impedimenta, which means like, cart or luggage, right? But in the plural, impedimenta is hindrance. It changes its meaning. That's what happened to, was it Hannibal, trying to invade Rome over the Pyrenees? He had too much luggage, too many baggages.
Oh, it's the guy who went through over Alps.
Yes.
Yeah, it's Hannibal Barca, whatever his last name.
Anyhow, the point of it is, to address your question, if I'm looking at some really attractive situations and I manage 600 million, which is about what we manage today, that's a good number, right? Mm-hmm. Maybe it's too much. I don't know. But if I'm managing $1.6 billion, it becomes much more difficult. I can't buy 200% of company X or company Y. So it was not in the best interest of all of the partners for us to have to maneuver or try to maneuver with this very large numerator, this assets. The original, all the funds are named after islands, and all the islands share a characteristic that they're hard to get to. So the Tonga Islands, where I delivered some boats years and years ago, are surrounded by a lot of reefs, and they're very beautiful if you can get there. But the cruise ships are not going in there because of the shoals, because of the tides, the shallow bays, the atolls, and so forth. It would be a disservice to my investor base to say, oh, I was managing 600,000. Now I'm managing, $1.5 billion and nothing's changed. That would be disingenuous. And so for what I do, it's not scalable, but there's nothing the matter with return of capital, right? And I might do that again. If we have good years, I'll just be like, here you go.
It's interesting. You started classics and
briefly.
Maybe that's why. That's my question would have been, everyone at that era tried to build empires, and here you are saying, okay, no, it's just too much.
There were other things behind it too. It's, I mentioned before the preferred habitat philosophy. So I think that an athlete or whatever performs best if you're enjoying what you're doing. And maybe this isn't discussed enough, but I think that hedge fund managers, there is an analogy to sports. You need to be in the zone. You need to be focused, and you need to have this kind of, there have been some books written about this recently. You need to have this kind of mojo, which is intact. And if you're unhappy and you're stressed and you're not sleeping well and you're drinking too much or whatever that might be, that's a disservice to your limited partners. And I can tell you, having done this, not only is it quantitatively difficult to deploy $2 billion in the type of stuff that I do, but it's not as fun. So there's an inverse relationship to your spirit and your enjoyment in the AUM. And I can tell you without question, I was happier managing 75 million than I was managing, $1.5 billion. There's also a level which is more philosophical of diminishing return, right? So if you're a hedge fund manager and you're getting paid 20% of the profits and you're producing numbers, above average numbers, when is enough, right? And you do that over 31 years. And so I did retire about 18 years ago.
Why did you come back?
I came back because there are very few businesses that can cure my own intellectual curiosity like the investment business, right? I'm reading a book about a friend of my dad's who's passed away, and it's an autobiography of Phil Carret, and he used to go to work at age 94. By the way, he would take the bus to his Midtown office.
Wow.
At age 94. And one can ask the question, why? What is it about this business that produces this unusual behavior in the practitioners, whether it's George Soros or Sir John Templeton or Roy Neuberger, and you could go on and on. Some of these individuals have passed, but I think all of them recognize that there is a incredible intellectual stimulation on a horizontal level that does not exist in vertical profession. So if you're a dentist and you're a successful dentist, the utility of your millionth cavity is not high, right? It's you've done it before, you're not really learning that much, and you're probably not deriving that much satisfaction. But when I conduct quantitative screens, or I just went down to Philadelphia and visited a couple companies, and then I visited New York, get off the train, I'm excited, right? I've been doing this 31 years, and it's like I'm really excited the night before because I'm going hunting, I'm going fishing, right? I may be disappointed when I get to the river, when I get to the meeting, but at least going into the meeting, I believe that there is something new and something interesting. And then you meet these people, some of whom are really remarkable, right? Steve Jobs was a remarkable entrepreneur, very eccentric, very demanding, very unusual. And if you're a dentist, you don't meet those people.
Yeah.
But if you're investment management, you get the opportunity to meet these people. And that, to me, it's the best business in the world, because you're not really working. You're just kind of, taking in information. It's not and yet another Buffettism is you want to tap dance to work. And if you're managing $2 billion and doing, small cap stuff, you're not tap dancing to work. You're under a lot of strain, and you're missing out on some of the very best attractive opportunities.
If you weren't an investor, if you just worked on some other job, would you invest in individual stocks, or would you be just doing some ETFs?
Do I answer that in the context of what I know, having been an active manager?
No, just
I don't know. I don't know what I would do if I had headed off into a very different. I was interested in journalism, at one point. That's a very interesting question. I suspect I would just rely upon allocators to make those decisions for me.
Well, Carlo, thank you very much for your time.
Sure.
I appreciate it.